Vanguard looked at its own data and found that almost 7% of traditional IRA holders missed a required withdrawal in a single recent year. Just one mistake, one missed deadline, and the average penalty those people paid was over $1,100, on top of the taxes they already owed. Now multiply that across every traditional IRA and 401k in the country, and you start to understand why this single mistake is quietly costing American retirees a combined total in the billions every single year. Here's the part that should bother you. This isn't a complicated tax loophole. It isn't some obscure provision buried in a 400-page bill. It's a simple deadline. The IRS requires you to withdraw a minimum amount from your retirement accounts starting at a specific age every single year by a specific date. Miss it, miscalculate it, or forget about an old account from a job you left 20 years ago, and the penalty kicks in automatically. No warning call, no grace period conversation, just a 25% penalty on whatever you should have withdrawn, in addition to the ordinary income tax you already owe on it. And here's what almost nobody explains clearly. This rule changed in the last few years. The age it kicks in moved. The penalty amount moved. The accounts it applies to changed. If the information sitting in your head about RMDs is more than 2 or 3 years old, there's a real chance it is now wrong. And an outdated assumption is exactly how thousands of retirees stumble into this penalty without ever meaning to. I'm Lucien Vale, and today I'm walking through exactly how required minimum distributions work under the current 2026 rules, the 5 specific mistakes that are draining the most money out of retirement accounts right now, and the proactive steps that keep the IRS from taking a single extra dollar of your retirement savings. Stick around for the 4th mistake. It has nothing to do with forgetting a deadline. It's about an account most people don't even remember they have, and it's catching people who think they're doing everything right. Subscribe before we start. This channel breaks down retirement rule changes the moment they happen, so you're never the one finding out the hard way. Let's get into it. Let's start with the basics, because the rules genuinely have changed, and getting the foundation wrong is where most of these mistakes begin. A required minimum distribution is the minimum amount the IRS forces you to withdraw every year from most tax-deferred retirement accounts. Traditional IRAs, traditional 401ks, 403bs, and similar plans. The entire point is simple. When you contributed to these accounts, you got a tax deduction. The government let you delay paying tax on that money for decades while it grew. RMDs exist to make sure that, eventually, the IRS actually collects that deferred tax. These withdrawals count as ordinary taxable income in the year you take them. That matters more than people realize because a large RMD can push you into a higher tax bracket, increase the taxable portion of your Social Security benefit, and even trigger higher Medicare premiums through something called IRMAA, an income-related surcharge most retirees have never heard of until it shows up on a Medicare bill. The age requirement changed. Pay close attention to this. Under the Secure 2.0 Act, the age at which RMDs begin depends on your birth year. If you were born between 1951 and 1959, your RMDs start the year you turn 73. If you were born in 1960 or later, that age moved to 75. In the year you first become subject to RMDs, you get a one-time grace period. You can delay that very first withdrawal until April 1st of the following year. Every year after that, the deadline is firm, December 31st. Here's the detail that catches people completely off guard. If you use that one-time grace period and delay your first RMD into the following spring, you now owe 2 RMDs in that same calendar year. The delayed one from the prior year, plus the current year's regular RMD. 2 taxable distributions landing in the same tax year can push you into a meaningfully higher bracket and increase what you owe on Social Security and Medicare calculations. Nobody warns retirees about this stacking effect in advance. Roth accounts are now treated differently, and this is genuinely good news. Here's a change worth knowing. Roth IRAs have never had RMDs during the original owner's lifetime, but Roth 401ks and Roth 403bs used to be different. They required distributions even though Roth IRAs didn't. Secure 2.0 fixed that inconsistency. As of recent years, Roth 401ks and Roth 403bs no longer require RMDs during the original account holder's lifetime either, bringing them fully in line with Roth IRA treatment. If you've been taking RMDs from a Roth workplace account out of habit or outdated advice, you may not need to anymore. Mistake 1. Missing the deadline entirely. This is the single most common and most expensive mistake. Life gets busy, people assume their brokerage will calculate and send the RMD automatically. And sometimes it does, but not always, and never with certainty across every account type. The penalty for a missed RMD is 25% of the amount you should have withdrawn but didn't. That's on top of the income tax you still owe on that money once you do withdraw it. The good news, if there is any, is that this penalty used to be a brutal 50% before Secure 2.0 cut it in half. And if you catch the mistake and correct it within roughly 2 years, the penalty can drop further, down to 10%. In some cases, if you can show the IRS the missed RMD was a genuine, reasonable mistake that you've taken steps to fix, the penalty can be waived entirely. But none of that happens automatically. You have to catch it, fix it, and in some cases, formally request the reduction or waiver. Mistake 2. Forgetting about old accounts from previous employers. This is becoming one of the fastest growing causes of missed RMDs, and it's almost never intentional. Someone worked 4 or 5 jobs across their career, each with its own 401k. They rolled some into an IRA, left others sitting where they were, and over 20 or 30 years simply lost track of an account that's still sitting at a former employer's plan administrator. Every single one of those accounts is independently subject to its own RMD calculation. The IRS does not care that you forgot it existed. If you have multiple IRAs, the good news is you can calculate the combined RMD from all of them and withdraw the total from a single account. That flexibility exists. But 401ks from former employers don't get that same combining treatment. In most cases, each separate 401k requires its own individual withdrawal. Forgetting even one of these accounts means an automatic calculable penalty the moment the deadline passes. Mistake 3. Miscalculating the amount using outdated life expectancy tables. Your RMD amount is calculated by dividing your account balance as of December 31st of the previous year by a life expectancy factor from IRS tables. The IRS has updated these tables in recent years. If you or whoever is helping you calculate your RMD is working from an old worksheet or an old version of these tables, your math will be wrong. Even if you withdraw something, you may not be withdrawing enough, and the shortfall still triggers the same 25% penalty on the difference. Mistake 4. Getting inherited IRA rules wrong. This is the mistake catching the most people by surprise right now, and it's the one I promised you at the top of this video. If you've inherited an IRA from a parent, a sibling, anyone other than a spouse, the rules are dramatically different from your own retirement accounts, and they change significantly under the Secure Act. For most non-spouse beneficiaries who inherited an IRA from someone who died after 2019, the entire account must be fully distributed within 10 years of the original owner's death. That's a hard deadline on the full balance, not just an annual minimum. And here's the trap. If the original account owner had already started taking their own RMDs before they passed away, IRS guidance in many cases requires the beneficiary to continue taking annual distributions during those 10 years too, not just wait and withdraw everything in year 10. Some beneficiaries assume they have total flexibility for a full decade and can wait until year 9 or 10 to take anything out. Depending on the original owner's RMD status, that assumption can be wrong, and skipping required annual withdrawals during those years can trigger the same penalty structure as any other missed RMD. There are exceptions. Certain eligible designated beneficiaries, including spouses and a few other specific categories, can still stretch distributions over their own life expectancy instead of the 10-year rule. But for most people who inherit an account from a parent, the 10-year rule with potential annual requirements is now the reality, and it is one of the most misunderstood areas of retirement account taxation today. Mistake 5. Triggering avoidable tax and Medicare consequences by not planning the withdrawal proactively. This last one isn't about missing a deadline. It's about technically complying with the letter of the law while still costing yourself unnecessary money. Taking your full RMD as a single lump sum late in December without any tax planning can push you into a higher bracket for that year, increase the taxable portion of your Social Security benefit, and trigger IRMAA surcharges on your Medicare premiums for the following year. Surcharges that, once triggered, can take up to 2 years to fall back off your account even if your income drops again afterward. None of that is a penalty in the technical sense, but it is real money that a small amount of proactive planning, done months in advance instead of in the final week of December, could have reduced or avoided entirely. Step 1. Build a complete inventory of every retirement account you have ever opened. Before you can calculate anything correctly, you need a full list. Every 401k from every employer, every IRA, every old account you may have forgotten. If you suspect you have a lost or forgotten 401k from a previous job, contact that former employer's HR department or plan administrator directly to confirm whether the account still exists and what its current balance is. Step 2. Confirm your exact RMD start age based on your specific birth year. Don't rely on a number you heard a few years ago. Confirm directly, based on your birth year, whether your first RMD year is the year you turn 73 or the year you turn 75 under current rules. This single number determines every deadline that follows. Step 3. Calculate using current year IRS life expectancy tables, every single year. Do not reuse last year's calculation or a worksheet that's more than a year old. Confirm you're using the current IRS life expectancy table for your specific situation, especially if your account type or beneficiary designations have changed. Step 4. If you inherited an IRA, get a written determination of which distribution rules apply to your specific situation. Because inherited IRA rules now depend on your relationship to the original owner, whether they had already started their own RMDs, and which specific beneficiary category you fall into, this is not a situation to guess on. Get clear written confirmation from the plan administrator or a qualified tax professional of your exact required distribution schedule before you assume you have a full decade of flexibility. Step 5. Set your RMD withdrawal early in the year, not in the final weeks of December. Taking your distribution in the first half of the year, rather than scrambling in late December, gives you time to plan around the tax bracket and Medicare premium implications, time to correct any calculation errors well before the deadline, and removes the risk of a processing delay at your brokerage causing you to miss December 31st by accident. Step 6. If you do miss a deadline, act immediately. Don't wait. If you discover you've missed an RMD, the path to reducing that 25% penalty down to 10%, or potentially having it waived entirely, depends on correcting the shortfall promptly, and in many cases, formally documenting why the mistake happened. The faster you act and the better documented your correction, the stronger your position with the IRS. Required minimum distributions are not optional. They are not flexible, and the penalty for getting them wrong is calculated automatically the moment the deadline passes. The rules around age, calculation method, and inherited accounts have all shifted in recent years, and an assumption that was correct 5 years ago can be exactly wrong today. The 6 steps I just walked through aren't complicated. They take an afternoon of organization, not a financial planning degree. But that afternoon is the difference between keeping your retirement savings fully in your own control and quietly handing the IRS an extra 25% penalty on top of taxes you already owed. If you know someone approaching 73, someone managing an inherited IRA, or someone who's mentioned losing track of an old 401k from a job decades ago, send them this video. The deadline doesn't send a reminder. This video is the reminder. Subscribe to this channel for more breakdowns of the retirement account rules that change every year, and that nobody explains until the penalty already landed. I'll see you in the next one.